bring in Mark Lehman. He's CEO with JMP Securities. And Bryn Talkington is managing partner with Requisite Capital Management. Wonderful to have you both here. Bryn, I want to start with you because, you remind people that Amazon at one point in 2001 did trade all the way down to $6, and that it's very hard to value some of these companies. So for investors today, how do they find an Amazon versus one that I think you might be, or maybe a Tesla versus one like a Nikola or something like that? I know you're a little bit more cautious on.
Yeah, I think that, first of all, what all these companies, whether it's Amazon or Microsoft, Apple, Tesla, have in common is they're all part of the NASDAQ 100, which are part of the QQQs. So I think that's a great place to start, first of all, when you're looking at companies that are growing, is start with something as simple as the QQQ, which is my version of the S&P 500. I definitely think, though, you have to discern, though, because I don't know anyone that stuck with Amazon at $6 back then. And so you have to have a stomach of steel and you have to do good research, because for every Amazon, there's 20 more Nikolas or Lordstowns, which have no revenue and somehow are publicly traded companies. And so I think it's a great question, but a complicated answer. But ultimately, I would start with the Qs to do really good research of finding great companies versus just looking at the S&P 500.
And maybe one sort of follow on to that, if people are saying, okay, well, what's the difference is, Amazon had gross profits of $656 million in 2000. I mean, most of the companies we're talking about today, the sort of smaller valued ones, the recently public ones that are more of a business plan than a business model, would you say that that's the place to start is frankly with the balance sheet?
Always. And so, Jeff Bezos writes wonderful, annual letters. And in that, I think it was the 2001 letter, the first word was ouch, right? As he recognized that the stock was down 80%. But as you point out, their gross profits, were up multiple folds in that 1 year. So what you want to do right now is take advantage. There's a lot of great companies out there that are off 20, 30, 40% that have really long runways. And there's also in the crypto space, there's been, once again, I think that's a big area that you're going to see tremendous growth. But to point out from the Wall Street Journal article, a ton of volatility and a lot of FOMO as well.
Sure. And I know to get specific here from your notes, Coinbase, Roku, Palantir, Cathie Wood's ARK Fund. I mean, those are names that you are sticking with sort of in this sort of moment in time in the market. Mark, let me turn to you because you have similar thoughts, but a little bit different, maybe places where you would be putting capital to work, like C3 AI and so forth. So first thing, Mark, like you said, having gone through the dot-com bubble and bust, what similarities are there? What differences with today's trading environment?
Well, I was back, I think of March 1st, 2000 is kind of the peak of the NASDAQ, like we just saw, because my youngest daughter was born that day. And I almost named her NASDAQ, but that would have been bad. So listen, the similarities are there's lots of reporters and lots of articles being written, and they've been written for years, by the way, that this market is overvalued. That's very similar. The difference, of course, is that some of these companies are going to be around for a very long time, and we're questioning valuations, not permanence. So Tesla is going to be around for a very long time. They're making great strides in other areas besides making automobiles. The question is, what do you want to pay for it? And I think that's a big difference from Pets.com and a lot of companies that, frankly, never had a business model and got public. The other thing I want to caution, the viewers and lots of people is to say, because a lot of the retail trade is in here, it must be a bubble and it's not going to survive. And I point to, frankly, some of these meme stocks and some of these companies like Hertz, which people looked at with a great lack of affection last year. And Hertz not only paid off their shareholders who bought the equity, which was supposed to be worthless, it's wildly profitable these days.
Shepard Smith here. Thanks for watching CNBC on YouTube.